Hello investor and traders, welcome back to another episode. So in the last previous video, I talked about what is a cover call and my example. Well, in this episode, I'm going to talk about the worst case scenario of doing this type of trades. Yes, there's always pros and the cons. And yes, it is a trade because regardless if you buy options or stock, when you buy and you sell, that's considered a trade. So what is the worst case scenario? Pretty much the foundation, like the whole concept. All right, so let's just get to it. So my friend said, if it is a win-win situation where you collect free premium, right? Then why don't everybody do it? Well, then I said that because not a lot of people can buy 1,000 shares of THO. Remember my last episode? I said I own 1,000 shares of THO. That costs roughly around $110,000. Now, if you have $110,000, you could do this type of trade. It's called cover call, right? Now, let's say I don't have $110,000, but I still want to do this type of trades. That's called a naked call. All right, so let's get to it. So what's the danger of it? I'm going to pick an example of GME. Remember, this is the worst case scenario, okay? But it can happen. Hey. All right. So GME, you can do weekly option with GME. So here's a screenshot of GME right here. You can see the September 24th, October 1st. These are Fridays. Each of these will represent 1 week. Every Friday, the option is expired, okay? To let you know. All right. So here, let's go back to a bit of history of GME. Remember, early this year was the Reddit community spiked the hell out of GME, where it supposed to go bankrupt. So here's the date, right? January 25th. So let's go back to the date here, so that make an example more real. Okay, it could happen to anyone. I'm pretty sure it happened to people here. 25th is on a Monday. Agreed. So when remember due on Friday. Friday the 29th. Okay, 29th. So keep that in mind. All right. On this candle, you decided, okay, I do not think that this can go back above 150 or 160, the high of this right here. So you want to do a naked call. Remember, a naked call that you are temporary bearish. You do not think this stock can go back above 160, okay? On the 25th. All right, right now it's at 76. Looking good, right? You're looking good. You are making money. But here's the next day. It's going back up. Hey, but not up above 160. So you're safe for now, okay? And then the next day. Uh-oh. Not looking that good. It looks very bullish because it's going up, right? All of 300. By now you're probably freaking out, but hey, you still have a couple more days because this is only the 27th, right? You have to till the 29th. Remember, 29th is Friday. Next day. All right, all right. Looking a little bit better, right? Remember, you do not want this to go above 160. At this point, you were happy because it's below 160. But now it closed at 193, which is kind of not good. But then again, this is the 28th. Here's the date to remind the viewers, the 28th. Your contract due on the 29th, the next day. So next day, what happened? Uh-oh. Not looking so good now because it closed at 325. Remember, this is a worst case scenario concept, okay? So I'm going to screenshot this and write some notes to explain. If it's easy, why don't people do it? All right, so here's the worst case scenario. Remember, this is a basic concept, okay? You do a naked call at 160, okay? You want the stock price by this date, the 29th, to go below 160. Unfortunately, that didn't happen. It closed at 325. So what's going to happen to your account? All right, so this is pretty much the overall basic concept. So here's the thing. If you do not have enough money to buy, let's say you do 10 contract, okay? So how much is that going to cost? Well, if you don't have enough money, what's going to happen? So that's about $325,000 position that the broker have to buy because you did a call at 160 now at this price. So what's gonna happen now, right? And you don't have first of all, you don't have 160,000. What make you have 325,000, right? If you did have 165,000, I would recommend cover call instead of naked call because this is the danger of it. So what's next? Well, the broker will force you to buy it anyway without your consent. Remember, because you did a contract, right? Someone bought the contract from you. So that means you owe the broker 325 temporary. However, your agreement was to sell it at 160. So cut off some slack a little bit. So that means the stock price 325 minus 160. So that's the difference of 165, which equivalent to 165,000. So this is how much you owe the broker now. This much negative in your account on the next day. The overall basic concept, okay? It's more in depth than that, but this is just a general idea. So what's going to happen now? I don't have 165,000. Well, let me change the color to green. Dun dun dun! Margin call. Yeah, to be honest with you guys, I never had a margin call before, and I've been trading for 7 years because I know the danger of margin call. Anyways, you get a margin call. So what does that mean? That means you owe the broker 165,000. So the broker now is in control of your account. You need to pay the broker back this amount, just like you owe a bank. But now this is a pretty big number. So that's why it is so dangerous of doing naked call because your loss is unlimited potential. That's why for me, right, I did a cover call. That means in my case scenario, my case, okay, I already own the shares at 160, right? I did a cover call. And now this thing went up to here. What's going to happen to my shares? I'm just going to, that means my shares are gone. I no longer own 1,000 shares of this. Plus, I get to keep the premium. Oh, yeah, you get to keep the premium too here, too. Plus, keep premium, which is not much. Well, it would be a lot because it is GME. So this will be green. But overall, your negative capital gain, capital loss is override this part right here. So in the end, you still down the shithole. So that's the pretty much basic concept of the danger of doing naked call. All right, see you guys next video.